If you're retiring early or have retired early or you're self-employed, one of the things that you might be concerned about is the cost of health insurance premiums, especially if you're using health insurance through the marketplace. In this video, I'm going to explain exactly how premium tax credits work. We'll take a look at a real client scenario and talk about what you might be able to do to decrease the amount of money you're spending on health insurance premiums. I'm Kyle Harper, founder of Harper Financial Planning, a fee-only financial planning firm with no asset minimums. We help people retire better. So it's important first to understand exactly how ACA subsidies work. They're based on three things. Number one, your household size, specifically your tax household. Number two is your modified adjusted gross income. Number three is the type of health insurance plan that you select for your family, which is location dependent. The first thing you'll want to do is figure out your tax household size. This is the number of people on your tax return, you and your spouse and dependents that you claim for health insurance. So if you and your spouse file separately, you would be two different tax households even though you live together. The example that we're going to look at today is a married couple with no children dependents based in Charleston, South Carolina. Next, you'll want to know your modified adjusted gross income. For ACA subsidies, your modified adjusted gross income is defined as your AGI plus your non-taxable Social Security benefits, plus any tax-exempt interest you may have from things like municipal bonds, plus any excluded foreign earned income. You can follow the instructions on Form 8962 to help you calculate your modified adjusted gross income. Some of the other things that you'll need to know, which we'll take a look at here in a second when we look at our case study, are number one, what the federal poverty level is in your state. For most states it's the same, but for Alaska and Hawaii they have their own federal poverty level. Number two, you'll want to know whether or not your state is a Medicaid expansion state. For example, this couple that we're going to look at is in South Carolina, which is not a Medicaid expansion state. And that's going to matter when we talk about these health insurance premiums. Number three, you're going to want to know what the second lowest cost silver plan is in your area through the marketplace. It is dependent on your location, typically your zip code. The cost of the plan for you can be found on healthcare.gov once you put in your family information. The way the calculation works to determine what your tax credits or ACA subsidies are going to be to help offset the cost of health insurance premiums is it's going to compare your household's modified adjusted gross income to the percentage of the federal poverty level. Technically, we'll take the second lowest cost silver plan annual premium and we'll subtract your expected contribution to find your tax credit. Your expected contribution for your health insurance premiums will typically be limited to a percentage of your income. It starts out around 0% and goes up to about 8.5% of your income, and it's defined by the Affordable Care Act. In prior years, your expected contribution was capped at 8.5% of your income. But those additional subsidies have ended, and so it's no longer capped at 8.5% of your income. If your income is greater than 400% of the federal poverty level for your household size, your expected contribution could be as high as 10%, 12%, 15%, or more. Once you know your tax credit amount, you can begin shopping for plans. If you select the bronze plan, the tax credit might cover some or all of the cost. If you select a silver plan, it's going to cover less of the cost. If you select a gold plan, it's going to cover even less as well. Of course, very few people know exactly what their modified adjusted gross income is going to be at the start of the year. So when you do your taxes and you fill out Form 8962, if you underestimated your modified adjusted gross income, then you'll have to repay those tax credits at tax time. So what we're looking at here is the minimum and maximum modified adjusted gross income numbers needed for these clients to qualify for premium tax credits. So for household size of 2, you can see that the minimum modified adjusted gross income number is $21,150. If their income falls below that, they are not eligible for premium tax credits. And if their income is greater than 400% of the federal poverty line, which is $84,600, they also are not eligible for premium tax credits. So their modified adjusted gross income needs to be between these two numbers in order to be eligible. So let's take a look at what this actually means for them if they were to select the second lowest cost silver plan in their area. These are their real numbers. If their income was too low and they did not qualify for premium tax credits, they would pay $2,200 a month for their health insurance. As soon as they cross over that federal poverty line, they're eligible for those tax credits. And you can see that at that point, their monthly premiums would be $45 per month. As their income grows over time, you can see by the mid-40s, those monthly premiums are $380. Just before they cross over that maximum modified adjusted gross income threshold, those premiums are $710 per month. As soon as they go $1 over that threshold, they would be back to paying the full cost of that plan, which is $2,200. So for these clients, it was really important that we kept their income within a specific range so that they didn't end up paying full cost for their coverage. Let's take a look at the actual information for these clients and then talk about what we decided to do and some strategies that you may be able to use as well. So these clients have a net worth of about $1.7 million. You can see that the majority of their net worth is in investable assets. And of those, the lion's share is in tax deferred accounts. That's going to be like traditional 401ks, traditional IRAs, assets they have not yet paid taxes on. They do have some Roth dollars too. They also have some taxable brokerage assets. And two of the concerns that they had when they came to me were the taxes that they would owe on these pre-tax assets. They were asking if they should pursue doing Roth conversions. And secondarily, they have some individual stock positions in their taxable brokerage account that have appreciated a good bit in value and now make up a larger portion of their portfolio than they're comfortable with. And so they're asking, should we go ahead and sell some of those and diversify those dollars? Our recommendation to them ultimately was, let's build out the rest of your portfolio around some of those consolidated positions, because if we sold all of those in 1 year, we would end up having income that was too high and disqualify ourselves from those premium tax credits. And for now, we're deciding to forego doing Roth conversions so that we can keep their income just over that 100% federal poverty line. The impact for them on waiting to do Roth conversions isn't terribly significant because they still have over a decade between now and when they ultimately will be subject to the RMD rules. And the required minimum distributions on tax deferred assets of this size wasn't enough to push them into a significantly higher tax bracket at that point in time. So the biggest bang for the buck with them was optimizing their plan for these premium tax credits. So what might this mean for you if you're one of those people who is considering early retirement, or you have retired but you're not yet Medicare age, or you're self-employed and you're looking at health insurance coverage through the marketplace? The largest tool that you have at your disposal is intentionally increasing or decreasing your modified adjusted gross income. Let's first talk if you're in the situation where you're at risk of having too low income because you're in a state that is not a Medicaid expansion state. These clients hypothetically could have been in that position last year if they had retired sooner and were living off the excess cash that they had because the only income they would have had was a small amount of interest and dividends generated by their portfolio. Something that I would have recommended to them then is let's intentionally realize some of those unrealized capital gains so that we get your income above that federal poverty line and make sure you're eligible for those premium tax credits. Another strategy that we could have employed, again when they were at risk of having too low an income, is we could have done a Roth conversion. Even if they didn't need those dollars for income today, moving those dollars from traditional retirement accounts to Roth is going to generate taxable income on the tax return, and that'll keep them above that federal poverty line as well. Alternatively, if you're in the position where you risk having too high of an income to be eligible for tax credits, there are still some things that you may be able to do to decrease your modified adjusted gross income, such as making pre-tax contributions to traditional IRAs or traditional 401ks if you still have some earned income. If you're self-employed, it might look like depreciating assets or moving expenses into this year to help offset some of your business income. Sometimes there is no way to get your income low enough to qualify you for ACA subsidies because you retired and you have a sizable pension and that alone makes you ineligible. In that case, what we want to do is be aware of what the health insurance premiums are going to be so we can factor that expense into our plan and make sure that we're still able to meet those expenses and maintain our desired standard of living as we move you into and through retirement. Hopefully that was helpful for you and shed some light on exactly how ACA subsidies work and what you might be able to do to put yourself in a position to pay less in health insurance premiums in the future. If so, please subscribe for future videos that may be useful for you. I'd highly encourage you that if you're one of those folks, again, who is self-employed, planning to retire early, or you have retired early, and you're using the marketplace health insurance, you should work with a financial advisor, a health insurance broker, and a CPA to coordinate this type of strategy, because being wrong can cost you hundreds if not thousands of dollars every month in unnecessary health insurance premiums. If you need someone to help you coordinate this for your personal financial plan, feel free to reach out to us at Harper Financial Planning. I also have a video that I'll link here with instructions on how to find a high quality, fee-only financial advisor near you.